I'm going to go ahead and kick off. Thanks for joining this evening. And if my dog comes crashing through the door or kids yelling, I apologize in the background. Since I'm at home office tonight, which is more comfortable, even though I don't get to get the feedback from you directly. And let me you can shout out a question as you like. I'll keep the mics open as we go, and that way you can go ahead and ask a question as you may have one. And if there's a feedback, then I'll have to mute everybody, and you can also send it through the chat line here. I think we got a full house, so that's good. So thanks for joining tonight. I thought I'd first start. The nice thing about being able to do this from desktop is we can get into a little bit more detail, and we'll talk a little bit more about the economy and kind of from a top-down approach. And there's so many economic indicators that are out there. And just to give you an example here, here's just 14 days worth. It's the last. So I bring up the last 7 days and the last and the upcoming 7. You can see these are things that we're scanning on a daily basis, and there's no one economic indicator that can give you some sort of portend to what the economy is going to do, because what you'll notice is that almost every economic indicator is always rearward looking. There's no way to look into the future, get my crystal ball out and say, oh, well, this is clearly what the stock market is going to do, or this is what the economy is going to do. There are plenty of people on television, behind me who will make comments about how they think the economy is going to go, or they think how the stock market is going to go. But nobody knows. There are some economic indicators that are more important than others. Give you a little idea of like whether what the Fed's going to do, or just for example, today, of course, the Federal Reserve met and kept interest rates where they are. They're expecting in September to raise. It's very high probability. You can see here the core PCE index is a good one to see how inflation is doing. One of the numbers I was talking about with staff the other day, and move this out of the way and get the GDP numbers up. You probably heard President Trump talking about GDP. We had a good number for the last quarter. And if you look at America historically, let me pick a color here like red, and you go back, and it's important that you be an economic historian. A lot of the new analysts and newly minted MBAs, I was talking how very few financial advisors last long in the business, and very few analysts last very long on Wall Street past 10 years. So you have this newly minted crop of MBAs who are constantly, who are constantly new to the business, and their time horizon is very short. And it's very important as economists that you take a very long-term approach and a long-term perspective. So you can see here GDP numbers, whatever economic number you're looking at, by the way, you want to make sure it's long-term and look at lots of economic cycles. But again, you'll notice even the GDP number, just like any other economic number, there's no way you can tell that, as you can see here, the gray line is where I've put in recessions into the mix going back to 1950. And you'll notice that the GDP, just like a stock market or the CPI for that matter, declines during every recession. So the recession hits, and you'll see that the GDP numbers decline. Same thing with inflation, right? Because things drop. So when is the next one going to occur? Nobody knows. You just don't know. And we've had this historical, America's had 4 to 5% GDP, and recently it's been confounding to economists that we've had about 2% GDP. And I've been modeling 2% GDP for a very long time now, just because we've been in more of a global economy. Inflation's been in check, productivity's been very high, and globalization is really keeping prices down and wages down. One of the other numbers I like to show often is, I'll show you here, a library here, where you talk about consumer consumption and wage growth. So for example, if I pay my employees more, if you look at personal consumption and income, if I pay somebody more, they're going to generally spend more, right? If your employer pays you more, you can see here with the blue line is income going back to 1960, and the yellow line generally traces right along with blue lines, right? So if people are getting paid more, as we see here recently, spending also increases commensurately with that. So that's not, and again, when you go through a recession, you can see these recession lines again. There's no economic indicator that says, well, look here, personal income is really good and spending is really good, so we're not going to have a recession. You can have a recession right in the middle of this. You can have a recession, you can see generally after. So there's no, you hear plenty of people and chartists and technicians and people who want to try to make a name for themselves try to call these things. They're really impossible to call, and it's not something that you want to guess about. So as an economist, what I always do is model for the worst case scenarios, best case scenarios, and a base case scenario. And so I'll say, okay, what if the bears are right? What if the doomsayers are right? And under that scenario, stocks do very poorly over the next 5 years. We could lose 40%. And that's certainly not a good outcome. Now, it doesn't mean Procter & Gamble is not going to be paying their dividend, because it quite likely will. But it doesn't bode well for stocks if a bear scenario happens. Now, I put this in at less than 10% possibility or probability, but it's possible. Conversely, stocks could make a tremendous return. We could make 40 to 50% here over the next 5 years. And also, I don't think that's a high probability, but maybe 10 to 15% where we could keep just rip roaring here with the stock market and doing very well. Most likely, however, is going to be our base case scenario, where this is the more likely scenario, where stocks do fairly well in the base case scenario. You can see, I think that international stocks are going to do better, and I'll kind of show you why later. And you can see also under the bonds why we're not investing in safe bonds and why we haven't been investing in safe bonds, because safe bonds effectively guarantee you a poor rate of return under each scenario, whether it's a bear scenario, a base case scenario, a bull scenario. So last week, one of our portfolio managers and analyst, Zach, was in Chicago with financial advisors. And, we try to tell financial advisors right now that, we'll ask them, okay, what's the 10-year treasury at? And if you look at the world, and just to give you an idea, world rates right now, this is something that's kind of cool that can't really do from a presentation, but I can kind of show you here. World rates are really low, right? Even the 10-year treasury for America is quite low. In Switzerland, you actually have to pay. Let me change colors here and go to something yellow that'll stand out very brightly. You can see Switzerland here, the 10-year bond, which is down here, is actually negative. So you have to pay Switzerland to hold your money right now. And here in the United States, you can see too, the 10-year just bumped over 3% again, as I was recently writing about. But across the world, you can see United Kingdom's at 1.3 for the 10-year. Germany's at 0.5%. Canada's only at 2.3. France is only at 0.7. Italy, surprisingly, is at 2.8. So the U.S. looks very strong relative to the rest of the world right now. And one of the reasons why, when we speak to financial advisors whom we sell our mutual fund to, we'll say, okay, Mr. Advisor, what are rates at? And we'll say, well, okay, the 10 years at 3%. And we'll ask, well, what do you charge your clients? And they'll say 1%. We'll say, well, what's 3 minus 1? Of course, the answer is 2. And we'll say, can your clients retire on 2% a year? And the answer, of course, is no, especially after 2% inflation is eroding that, and taxes, you're guaranteeing a negative rate of return. So we'll say, well, then why, Mr. Financial Advisor, won't you invest in high yield bonds, or a firm like ours that is, where we have a chance of making a positive rate of return, where we think in the worst case scenario, we still make, a decent rate of return. But in a base case scenario, our bonds could very well, if we get a 5.5%, 6%, could outpace U.S. stocks. And certainly under a bull scenario, again, our bonds could do well, but not quite as well as U.S. stocks. So we think you're better off that way. And the financial advisors will usually say something like, well, high yield bonds are riskier. And by the way, all these slides are available on our website if you want to grab one of the slides. Like, for example, if you go to our fixed income presentation here, where we're selling our mutual fund or presentation, we'll tell them, well, Mr. Advisor, you buy stocks for your clients, right? And they'll say, well, yeah, of course we buy stocks for our clients. And they'll say, well, you understand that high yield bonds are less risky than stocks, right? And they'll say, well, they don't really understand. So we'll show them, that, yeah, high yield bonds get stock-like returns. You get 7-8% returns with less risk as measured by standard deviation over long periods of time. Now you can see our bonds have done very well. We're trying to make that 5 to 6% with less risk than even high yield bonds overall. And that's always been our strategy, right? Is to try to get a nice 5 to 6% return for our bonds. And we've done that. If you look at, our bond portfolio or our fact sheet and you isolate just our bonds, you'd see that, over the last 10 years, we made 6%, in the last 15 years, 5.5%, and just under 6% since inception, dating back to 2003. And so, we try to explain these, and then tonight I'll kind of talk about a couple of bonds we own so you get an idea and a feeling for the actual company. So from an economic standpoint, right now, of course, the Fed's raising interest rates, and the U.S. looks good, which I was trying to show here in this slide, compared to those rates I was just showing you the rest of the world. So people are going to likely investors are likely going to continue to buy U.S. Treasury in relation to other countries. We're not buying foreign bonds because I'm not going to pay Switzerland to hold your and my money, and I own the same stocks and bonds that our clients do. So, it's nice that we have these things and kind of see all of these economic indicators, but understand the next recession's coming. We just don't know when. I don't know if it's next week or if it's 5 years from now. This recovery has been very shallow. I showed this in one of the client communiques. Let me grab it from, if I go back to, let's see, I think I sent it out in the third quarter of last year in one of the client presentations. Let me get Q3 of 2007. And in this presentation, this is it here. So I kind of showed that, and you'll notice that this recovery, most recoveries kind of snap back much quicker. And we saw that with the GDP numbers that I had pulled up earlier for you. Well, this recovery has been very tepid, right? This 2% GDP expansion. So we've got this gap between the two. So can this recovery go on for longer, even though it's been a long one? And the answer is, yeah, it can, because it's not overheating, and the Fed is in a good spot to really not have to raise rates quickly. And we'll talk about some of the risks of that. But for the most part, the Fed's kind of just slowly inching us back up. The ECB, of course, the ECB is in a much different position. They're effectively, and I kind of wrote about it here, they're not going to be raising rates until at least September 2019, and they talked about easing their quantitative easing program by stopping buying assets later this year. So we still look, again, we're going to continue to look good relative to the rest of the world. Now, talk about the elephant in the room here is tariffs. Obviously, has been a major issue for investors and for market instability. And having had luncheons in New York over the last few months, or every month this year with some senators, it's been nice to have the tax reform that we've had and the deregulation that we've had here in the United States has been really fabulous for the economy and for business. The tariffs could effectively erase all of the benefit that we've had from that if they were enacted. The hard part about Trump is even Republican senators really can't figure him out, right? They don't really know. And you can kind of see that even in the debate last year over the tax reform. They talked about how, Trump said no more than 15%, then no more than 20, and then he compromised on 22. And it's just, he tends to negotiate that way. And the market's kind of getting used to him from that perspective also. So in this sense, does he mean it? Well, last week, when he met with Juncker of the EU, he pushed back very hard on Germany. He's made some good points in the sense by saying, "Hey, Germany, why are you getting oil from the Russians when we're protecting you and trying to get some concessions for tariffs against American goods and products." Whether that'll work or not seems to have worked. Last week with some soybeans and industrial goods, and we'll see. What happens here with China as the saber rattling goes on. It's a non-military saber rattling, so it's an economic one, and generally it's in nobody's best interest. And I think it'll calm down. I think it's just Trump being Trump. But we'll see. It's certainly something that could hurt the stock market in the short term, or at least cause an emotional dampening on the returns that we're having this year. So most importantly, though, too, and I often talk about this, is for our clients. I say this is the most important slide: is that we've been through so much over the last 2 decades together, and none of our clients ever had to go back to work. They just kept collecting their income. $1 million today is pushing out about $48,000 a year of income in dividends and interest. And we've been through all of these crises. We've gone through, 250% corrections since I founded the firm 21 years ago. And yet we've survived that. And we've survived it because the companies we pay in, we're not investing in hope. We're investing in cash, right? We're investing in real companies paying us dividends. So when the market corrects, the yield actually goes higher. Or to put it differently, if you look at the actual income, even though the market is correcting here, which you can kind of see when we have a correction, the client's income changes very little. And for clients who don't need the income, we're reinvesting the dividends and interest, which it's nice that $1 million has grown for our clients over the last long period of time. But more importantly, now it produces a much higher income level for them because they've grown their assets by reinvesting and buying more shares during these ups and downs of the market. So I always kind of go back to that slide being the most important, as always. And just to give a quick recap on this year, the market's going pretty sideways this year. We're doing relatively well. Our U.S. stocks are up. You can see here, I just did this through the 31st, through the end of the month. Our U.S. stocks are up 5.7%. That's with our peer group, the Russell 2000 Value. I think we just sent out our 4-star rating from Morningstar earlier in this strategy, which you and I are invested in. It's about 26 stocks. We just bought Starbucks yesterday, actually, so it's 27 stocks now in the U.S. category. So here, we have, the Russell 2000 is only up like 2.5% this year, or the Russell 1000, is only up about 2% this year, 2.2 to be exact. The S&P 500, which is more growth driven, which I'll talk about the FANG stocks, is up 6.5%. So we're kind of keeping pace with that, which is a bit of a surprise because you got these FANG stocks, Facebook and Amazon, that have been zorching, although they've come back to earth just recently a little bit. Our international stocks are up 2%. That's with the EFA international stocks down a fraction this year, down about 0.3%. And probably our best performer on a relative basis is our unconstrained fixed income, which is up 2.6% because the bond market's down 1.5% this year. So we're up 3.25%. So we're doing okay this year, relative to, especially to other assets, but certainly not knocking the doors off in like other years. I just wanted to show that quickly, just give a relative performance update. Now, to get back to economics and the market valuations, I just want to show you that 10% corrections are very normal. We've had plenty of 10% corrections. Again, going back this chart, we took this one back to 1950. And you can see during a lot of these 10% corrections, the market's actually up during a lot of these years when the market corrects 10%. Now, of course, during the financial crisis, it was down heavy. If you go back to the 2000 tech bubble, it was down, although we were actually up a fraction in 2002, and we held in very well. I think we were down at worst case about 8 or 9% during this horrific 50% decline of the stock market. And so you can see during many of these 10% corrections, though, the market's actually higher, and that's why it's hard to take. When you look at CNBC here, and my neighbor Jim Cramer is yelling about something constantly. He just got off the air, and he's a good guy. He's really nice, nice guy, and but don't listen to what he says on TV, because you know, he was the guy who invented FANG, you know, and over longer periods of time, the market does much better, which you can see. You know, here's the 1-year returns, which are very volatile, but the green line here in Altrius, green and brown, the green line here you can see is much better from a rolling, longer term perspective, which is hard to keep, of course, when you're going day to day. Now, why we're finding international stocks so compelling right now is these things tend to go in cycles. So you can see if we go back to the, you know, the mid to late 70s, international stocks way outperformed. During the early Reagan years, U.S. stocks outperformed, and then later Reagan years and Bush years, international stocks. And of course, during the Clinton years, U.S. stocks, and during the tech bubble here, really outperformed after the bubble burst. And then during the Bush administration, early Bush administration, international outperformed, and then early Obama, international, and then late Obama was U.S. Now the question mark is where do we go from here? Does international now, you know, get a 5, 6, 7-year run? And it's a question mark. I don't know. So international stocks were outperforming a little bit this year. Last year they did, but this year, all of a sudden, as I just mentioned, international stocks are down a little bit with U.S. stocks doing well, but we're effectively split down the middle in our stock allocation for our clients right now, and that we're a little more than 50% bonds, and we're 26% U.S. stocks and 25% international stocks, because we're finding a lot of value there in international stocks. Now our stocks, you know, just going back from a historical perspective, if you look at, you know, U.S. stocks, I mentioned how we think the overall U.S. stock market is overvalued. However, we don't believe our stocks are. I don't think that our companies are expensive. If you look at, you know, the historical P/E ratio for stocks, it's somewhere around 17 times trailing earnings. Right now, it's like 22 for the S&P 500, and you can see here our stocks from a trailing is at 11. We're very, very cheap. We're even cheap relative to value stocks. So I think we're finding a lot of value. We're not paying too much. We never pay too much. And the other thing is we're getting a nice fat, almost 4% dividend yield. So we're getting paid to wait, which has always been our strategy, is to continually get paid to wait. So, and by the way, a nice thing about dividend stocks is not only can we have potentially better returns as we have, which is one of the reasons why we're 4-star rated, but we can do it with less risk if you use standard deviation as a risk measure. Now, in the book I'm writing this year, I'm saying you really can't use standard deviation because it's just a number for a portfolio, and I don't know that risk is measured by volatility, but the academics won, and so statisticians use standard deviation as a means, as one means. It's somewhat useful if you think about volatility, but it's not one you could say, you know, when you're looking at a real company, that it's the absolute quantity that you want to think about. And you know, I've talked a lot about FANG stocks lately, and this was coined by Jim Cramer, my Summit neighbor here in New Jersey, and certainly FANG's been just driving the S&P 500, right? Because the S&P 500 is market cap weighted, and so these largest companies, you know, you heard a lot of noise on TV today about Apple, which we own, approaching $1 trillion of market cap. And who's going to get there first? Is Amazon going to get there? Is Apple going to get there? And it doesn't really matter. Those are nice things, you know, Dow Jones, 24,000. These are nice round numbers that the media likes to talk about. But more importantly is we don't buy these kind of stocks, right? Whether it's Tesla or Amazon, where I have a lot of respect for the Jeff Bezos and Elon Musk. I'm not going to pay a gazillion dollars for a company. You know, for example, just if you go to, you know, Yahoo Finance here and you type in Amazon, we'll see what the stock selling at trailing earnings. It's some insane multiple, like 200 something times earnings. Now, yeah, 226 times earnings. There's no way. You got to hope that. I mean, that you got to think of businesses. When we buy a stock, it's not like we're buying some casino, right? Where we're buying a real company. And I often talk about when you're buying a real company, you have to think of it as if you're buying if you're buying anything. Let's say, I don't know, if I was going downtown here and I was buying an ice cream store, right? And let's say the ice cream store or the bakery, let's talk about Italian bakery, which I love up here in New Jersey, right? So let's say the Italian bakery is making $300,000 a year in profits. Now you or I, we might pay 3 to 5 times earnings for a small business. So we might pay, $1 million for this company, right? And we think, okay, over 3 years, we'll get back to our investment, and maybe we can make some more products to sell, and maybe we could sell coffee at that bakery too, and try to get our investment back early. Of course, we're gonna pay ourselves a salary though. We're gonna pay ourselves $50,000 a year from that bakery, just like the baker who owned it before us did, And if he has a good year, you get the profits too. That $50,000 salary that's your dividends, right? That's the dividends what we're buying a company. When you're buying an Amazon, you'd be, if you paid 200 times earnings for that, you're paying like 300 million. I don't even know the number on this, right? If I'm paying 225 times earnings at $300,000, I'm paying $67 million for that company. There's just no way I'm going to pay that much. My kids, I was asking my son this. I said, Maximus, would I sell the company if somebody paid me 100 times earnings? And he said, well, no, Dad. I know you wouldn't sell, because he's heard me say I wouldn't sell the company. But I said, well, at 100 times earnings, I'd have to seriously consider it, right? Because that's just a crazy multiple to pay for anything. So when you're buying a stock like Amazon, you're paying an insane multiple for a growth statistic. Even the go forward earnings is at 72 times earnings. It's just a huge, huge multiple. Not to mention that they're not paying you anything. You have to hope somebody comes along. There's no income, right? There's no, as you can see here, there's zero dividend here, right? There's nothing. You got to hope that stock goes up and people drive it higher, so that I have to sell it to get you your retirement income. Whereas with our strategy, we're buying a company like Procter & Gamble. So if I pulled up Procter & Gamble here, you'd notice that the company could be up or down in a particular day, but they're making just less than $4 a share, and they're paying out $3 a share, or they're paying you 3.6% yield. Now, Procter & Gamble only has to sell a little bit more Tide to get you a decent rate of return. And again, that's exactly what we're looking for. Is we're looking for that yield, which is much better than you can get from a bank, plus some growth from Procter & Gamble. And when I'm looking at a company long term, if you pull up a company like Procter & Gamble here, and we looked at PG, and if we looked at the financials of Procter & Gamble, kind of showing you behind the curtain here, some of the things I look at. It's funny, you think of productivity today and what technology has done. I mean, this would have taken me, we're just looking at Procter & Gamble here over years and years. This would have taken a team of 10 people a week to kind of pull all these numbers together back in the 80s or 90s. And if we go back here, you can see that Procter & Gamble, dating back to 2005, they paid 28 cents a share, 25 cents a share. Then they increased their dividend 31, then 40, and then in 2010, 48 cents a share and 60 cents a share. I mean, this is just a terrific company that's continued to raise its dividend over very, very long periods of time, and just recently increased their dividend again. Now their revenue is going to fluctuate, and they certainly have room, even if we went through a recession again, kind of like we did here. If you look at Procter & Gamble going back to 2008, where they made $79 billion and they dropped down to $76 billion, and then they started crawling their way back up, $77 billion, 81, 80, 74, 65, and here they are at $66 billion. Even if their earnings get cut a little bit, you'll notice that their cost of their revenue, they've done a good job. Here they were spending $39 billion, $38 billion, 39, 36, 32, 31, 34, right? So they're minding their bottom line. Same thing with their G&A expenses. So that their total operating expenses have dropped, by $10 billion just over the last decade, and that allows them to ensure that their net income has remained relatively stable over these years, and hopefully they'll eventually again be able to grow their top line and their bottom line over longer periods of time. But there's still plenty of room for them to pay their dividend to you and I. And we recently have moved into Procter & Gamble because if you look at it longer term, these kind of companies I couldn't buy years ago. You know, when you look back at our portfolio, I love consumer staple stocks, as you can see here. We've always been a big chunk in this large brown, 20 on average, about 20% of our portfolio. But then they got too expensive, so we've been out of Procter & Gamble and the Kimberly-Clarks and those type of companies in recent years for a long period of time, actually, about 5 years. Well, now you can see started loading up again this year because these stocks have all been knocked around 10, 15, 20% this year. Same thing with tech stocks. You know, if you go back to the early 2000s and you look at tech, which is the green here, we just didn't own tech. You know, it just had zero allocation tech because back then, Cisco and Intel and Microsoft, well, they were the Amazon of today. They were 100 times earnings. They were paying no dividends. But later on, when those stocks got killed after the tech bubble and they started paying a dividend, you can see we started investing in them. And Microsoft didn't pay for a long time. I mean, if you look at Microsoft, it was a pretty frustrating company. And then recently, if I pull up Microsoft here, you'll kind of pull up a chart. For a long time, it's tough to stay with a company when it's underperforming and you're just collecting that dividend yield. And then finally, it broke out for us. And recently, you know, last year we sold it because we think, okay, it's gotten expensive now. You can see this massive breakout. If I did a 10-year chart on Microsoft, you'll notice here that it was pretty it was pretty frustrating for a long time to be in Microsoft. It was performing with the market, but not really doing much. And then it finally broke out for us here. Now we sold it around here somewhere. Now it could keep going higher, right? You'll notice that Wall Street just, you know, I have a whole chapter in my book this year about how Wall Street funds, this is all they do, right? They just follow momentum. They follow the growth. You'll hear things like, you know, the trend is your friend, or don't fight the tape. And they're going long these kind of stocks that are high flying until they don't. You know, that's really the problem. And even a stock like we just bought, like let's look at Starbucks here, which we just bought. And just to show you, I mean, I got so many emails. Why don't we own Starbucks? Why don't we own Starbucks? And I said, it's too expensive. The dividend yield is far too low. We just don't want to be in the company. And it just had shot up. And, you know, I look like an idiot for some time here too, because Starbucks is really outperforming for a very long period of time. But now it's kind of taken a hit. And we think that this is a good entry point for us to own Starbucks long term because of the opportunities in China and the consolidation and a lot of the negative news around the company with Schultz stepping down and kind of getting involved in political things, which some of you may or may not agree with. So, you know, that's part of being a value investor, is thinking in a contrarian way, thinking, you know, like the aardvark, like our little mascot here. He's very different. He's unique. You know, he goes out at night alone and unafraid, and keeps his ears up, managing the risk and monitoring for the risk, and you know, eats the easy food. The easy food is ants, and that's dividends to us. You know, he's not going out there hunting for big game and swinging and missing. That's just not our philosophy. Our philosophy is to liken it to baseball. It's hitting singles, you know, and continually scoring runs. There's a much better way to not only become wealthy, but to stay wealthy. I've never met a client in 20 years of doing this that made wealth overnight. You know, Schwab and Fidelity and TD Ameritrade, a lot of the companies, they want you to trade. And every commercial, every minute is trade and options. And I've just never met anybody becoming rich doing that. You become wealthy doing your business well, slowly and steadily putting away for your retirement, and then protecting that return. And those slow incremental gains is how you become wealthy. And you know, they just to give an example of David Einhorn was a superstar portfolio manager and hedge fund, and I've got a whole chapter about all these hedge fund managers who blew up their strategy. Well, David Einhorn's fund's down 18% this year, 18% in an up market. And how do you do that? Well, you take gigantic risks in your portfolios. So many star, 4-star, 5-star fund managers of the decade over the last 20 years has done really well and then imploded because they take too much risk. And I remember my uncle, who just passed away 2 weeks ago, unfortunately. He called me and said, "Hey Jim, how about this CGM focus fund? This guy Ken Hebner's a genius." I said, "Yeah, he is, and he's really smart." And at that time, they were managing about $18 billion. He takes gigantic risks. So I said, "Uncle Tom, that fund is not for you. He takes giant positions," and you could see that in his holdings. Now, of course, he could be still shooting the stars out, but you can see, I don't know why he still manages 800 million even, which is more than double what we manage. But the amount of risk that you're taking, you can see this fund has just absolutely plummeted in recent years, and the reason is gigantic positions. So we equally weight our positions. At one, you can see he's got shorts on the Treasury market, a 32% position in Bank of America, which is crazy, 26% position in Vale, 25% position in Morgan Stanley. These are giant positions. And when things go wrong, when you start thinking that you're smarter than the market, you can see from a performance standpoint, it's just been dismal performance. I mean, I don't know how you lose 11% this year in an up market, and that's why he's in the bottom 100th percentile over the last 1, 3, 5, and 10 years. Amazingly, his 15-year track record is still pretty good. It's in the middle because it was so extraordinary during those first few years, and of course, all the money flew in. And it's just not what we do, right? We're equally weighting our positions. So if you look at our portfolio, right now as a snapshot in time, just give you a peek here. What you'd notice is that we tend to keep things very equally weighted, and we're usually buying the stocks when clients will ask us, "Jim, why are you buying a stock that's down 20%? So if a stock goes down from 1% down to 0.8, we're buying more shares because we still like the company. We don't think that underwear is going out of business, or Pepsi's are going out of business, or toilet paper or Kimberly-Clark's going out of business, and we're patiently buying more shares. So we'll buy that position back up to 1% and collect that nice 3% dividend yield while we're waiting for it, like Microsoft, to do well. Now, conversely, if the stock is shooting through the roof, let's say it's Apple and Apple goes up to 1.3%, well, we're trimming it back down to 1%. And risk management is probably the most important thing that I do for our clients. Living to fight another day, living to fly another day, being a former pilot is very important. And too many people take too much risk and they wind up blowing up their portfolios. And again, so you can see right now we're at 28% in U.S. stocks, and our international holdings are right at 25, almost 25%. So we're a little more than 50% in stocks, and then of course all the bonds that we own for our clients is the remainder. Again, because I don't know, if you look at it, 50% right now, we've been taking chips off the table, and you can see that from, if you look at our our strategy over the last decade here, or actually 2 decades. Let me show you over time. We've been as much as 60-70% in stocks. Here's our U.S. stocks, even in recent years, and our international is the green. So, if you take the green here and you add that U.S. component, and fortunately, we've been much heavier weight on U.S. stocks than international stocks, which have outperformed. Now, of course, we're equally weighted, right? We're at about 24% here and about 27% U.S. stocks. We're almost equally weighted. Now, it doesn't really matter where the company's headquartered. It matters more where the revenue is being generated from. But, we had, fortunately, a very small international allocation over the last, 15 years, especially since international stocks have generally underperformed U.S. stocks. But we've increased our bond allocation, from 35% now to 50%, because there are risks. There are risks that I believe are possible on both ends, the good side and the bad side of the economy, when we're looking from a top-down approach. So I just kind of wanted to show you that. Let me go back to some economic things here. I'm skipping around. Even though we talked about FANG here, and I kind of mentioned why these stocks are overvalued. Same thing for growth and value. The last time, value generally outperforms over longer periods of time, but recently growth has really outperformed. Now, again, it really hasn't hurt us this year. We're up 5.5%, even as a value manager this year for our U.S. stocks. But the last time we hit this, let's look familiar here. This was the dot-com bubble, right, when growth stocks were just pounding ahead. And again, Microsoft, Cisco, Intel, those kind of stocks were really outperforming, and dot-com stocks that had no earnings. And of course, value outperformed for a long period of time. Now the question mark is this value's turn? Maybe. Just in recent days and weeks, we're starting to see value start to outperform. So will we see value, over the next 4 or 5 years? It's possible. We're not going to chase this, though. We're especially not going to chase like everybody else. I mean, the mutual fund industry, having a whole nother chapter about that too, how they came out with .com, and then they came out with real estate funds, and then commodity funds, now alternatives, and now there's even ETF with FANG. Now, why you'd want to own an ETF with 4 stocks, FANG, I don't know why. Facebook, Amazon, Netflix, and Google. You could just buy those stocks. I don't know why you'd buy an ETF to do that, but the mutual fund complex is always going to try to make money, and they're going to put out there what's hot now. But we're certainly not going to chase that. We're going to stick with our discipline and not go after that. And even though we have an income strategy, it's been very smart for us over the last 5 years to stay out of, we've done 95% for our clients in our U.S. stocks over the last 5 years. But we've done it by not investing in utilities, which have underperformed and done okay at 70%, but certainly underperformed. XLP, I was just showing you, these are the consumer staple stocks like the Procter & Gamble's and those kind of stocks. We've stayed out of that sector because they were overvalued. We've stayed out of real estate. We've stayed out of business development corporations and MLPs. These are energy MLPs, which have done very poorly over the last 5 years and actually had negative rate of return. So to us, it's 3 things. My process has always been value, not paying too much. The second component is dividends, looking for growing dividends and above average dividend yield. And thirdly, looking for global revenue generation. We're looking for opportunities overseas, because if you look at America, we all own cars, we all use healthcare, we all have cell phones, but the opportunity set in places like China and India are gigantic for Procter & Gamble to sell Tide, or for Pepsi to sell more Pepsis or Frito-Lay in India or anywhere else, as they come into a middle class. One of our interns put together very nice slides on Starbucks, and most importantly, in his slides, let me grab one of them here, is the opportunity set really in China for Starbucks. And let me just give you a quick little glimpse into this. Find it here. Any questions, by the way, while I pause here for a second? Just kind of ramble on about stuff. I'm going to search for it. Here it is. I think there's some really neat slides that you'll kind of like here in terms of what we're looking at. So when we do analysis on a company, this is just one company, of course, of our 70-something that we own. But some things that are telling when you look at the opportunities, the average salary, of course, in China is just a little under 4,000 for the middle class in U.S. dollars. And the population density is obviously along the coast, Beijing, and Shanghai, and others. And when you look at, whether it's mobile payments or whether it's digital relationships, or the ability as the Chinese start to drink more coffee rather than than tea. Here in the United States, of course, Starbucks is sort of everywhere already, so it's streamlining and getting rid of underperforming Starbucks in places where it's not working. But the opportunity set in places that are growing in China, and there's one slide in particular that as they come into a middle class, and you can see that here, the potential and what Starbucks wants to do, and plan on doubling the store count by 2022 in China, and they're opening a store every 15 hours in China. So it's just an amazing opportunity. And a lot of times in America, we don't really think about things in terms of, we think of things from our perspective. My daughter said, "But Dad, there's a Starbucks everywhere." I said, "Yeah, but you got to look at the world from a global perspective." And coffee consumption in China is still very low from a standpoint of, look here. You look at what the coffee consumption in America is, 300 cups a day, and I probably drink 600 or more. But in the middle class in China is growing to 600 million. Is expected by 2022. The American population is what, 340 million or so. It's just incredible when you think that's just the middle class. And look, what do they drink a day? Nothing, right? As far as coffee consumption per capita. So it becomes an aspirational product, much like the Apple iPhone is aspirational in China. And my kids used to want to go to school holding a Starbucks coffee because it shows like they're in the hip brand. That's much of what Starbucks is in China. So the growth potential is just amazing in China. But again, you have to think long term, right? If you listen to the short term noise and you get wrapped up in, oh my God, Schultz is up and down as the CEO, and whatever noise it is, as value investors and contrarian investors, we're usually looking at where the opportunity is and to take advantage of that downturn. To go back to the company chart, and you look at that Starbucks chart, and you see just recently, year to date, and you see this large sell-off in Starbucks recently, and the contrarian in me says, "Oh, this may be a good time for us to go ahead and buy Starbucks for the long term for our clients." And by the way, you get to collect a really nice dividend yield. For years, if you look at Starbucks, in the early years, they didn't pay a dividend, right? So growth momentum investors will be diving into the company. If you go back to 2009, there was no dividend, and they initiated a dividend in 2010, but then they've continually increased that dividend since then, and have raised it again. So we're going up to like 36 cents a share here next quarter. So that's sort of the equity outlook side. Now let me talk a little bit about bonds. So our bond portfolio is again, we're investing in high yield. I always look for the worst case scenario, and if you look at worst case scenario right now, I actually use the savings and loan crisis when I was a midshipman coming out of the Naval Academy, a newly minted second lieutenant. It was horrible. We had the savings and loan crisis that drove default rates up to very high levels. So we use that as our worst case scenario. Is what if we're wrong, right? What if the 6% yield we're getting right now, we go into a horrific recession? Well, then what return are we going to get from our bonds? And under that scenario, you can see we still get a relatively flat return. And as you know, savings accounts aren't getting much right now. So we look at the opportunity cost and say, well, we could get 6% on the high end, or we could get a 0% return from bonds, in a horrible scenario. We'll probably still do better than stocks over the 5-year period under a recession. So it's one of the reasons why we do own bonds. And I was showing you that slide earlier, how high yield bonds can get stock-like returns with less risk. So it's one of the reasons why we like high yield right now. They're also not as interest rate sensitive. A lot of times people say, oh, Jim, bonds are interest rate sensitive. Well, yeah, but you can see here high yield bonds in recessionary periods do very well. And the reason why is if a company is, think of it this way, if the economy is doing well, the Federal Reserve is raising interest rates. Well, the companies we own, take an Avis Budget, is renting more cars. and businesses are doing well. So their profitability goes up. So when they go to the bank or they go to us to borrow more money, they're doing it at a lower interest rate rather than a higher interest rate. It's only the credit qualities that we're worried about. So when you look at our whole portfolio, if I ran a report, let me run a quick report just to show you all of our holdings right now. This is definitely an in-depth. I hope I'm not boring people out there too much. I'm going fast too, so try to cover this stuff in about an hour and a little bit, because I'm definitely getting into the weeds with these companies and showing you behind the curtain. So, I mean, you take a company like Avon, which is right here actually in Parsippany, New Jersey, or B&G Foods, right, which is also in Parsippany, New Jersey, which makes Green Giant. So for you and I said Avis. I was looking at Avon, and I meant to say Avis. So Avis budget is, you know, we own $1.6 million, you and I, in our portfolios, and we're getting a 5.8% yield to maturity. Now the bond price is going to fluctuate. You can see I paid just less than $100 for it. If something happened, a Morgan Stanley guy came out 2 weeks ago and said, oh, you know, cars are not going to be rented, and we own Hertz, the same thing. You know, Hertz went down that day. You know, I met with 28 management teams earlier this year, CEOs and CFOs of these great companies, and they're, you know, the credit quality is the most important thing for me to get right. The price, I can't stop the winds from blowing, right? But if we stay the course and the company doesn't go bankrupt, then they're still going to pay you that nice 5.5% coupon rate, regardless. So just as a mathematical example, if you had $10,000 invested in it, you know you're going to make $550 a year, and that's the bond interest you're going to get. Now your $10,000 could go down. It could go down 10%, right? It can go down to $9,000 or $8,000, where you see the price of the bond go down to $80, and you're getting nervous. But it doesn't matter, right? I mean, this is what's bad for the mutual fund, and why I tell our private clients we don't own the mutual fund for our private clients, because if an advisor calls us from St. Louis and starts liquidating, then we have to sell Avis budget. You'll see the price go down because we're selling, you know, $3 million of it in our mutual fund. But so what? You're going to get $100 back by April of 2023, and you're going to make that 5.8% rate of return regardless, as long as Avis budget doesn't go bankrupt, as long as Avon doesn't go bankrupt, as long as B&G Foods doesn't go bankrupt. And these are, you know, good companies. We just added Bed Bath & Beyond because of the Amazon threat, where we're making a nice 5.3% rate of return. Or you could, you know, for those of you who live in the South, you get a company like Central Garden & Pet, which makes Ambro and chase the fire ants away from your home. These are all good companies. Or Cablevision up here in New Jersey, New York, which is a competitive industry where we're making, you know, 5 to just under 6% on these bonds. And again, the nice thing is we don't own too much, just like we don't own more than 1% in any one stock. It's the same thing with our bond portfolio. You know, we own a lot of bonds for our clients, well over 100 in most all of your individual portfolios. So that if I showed you, you know, our unconstrained fixed income portfolio right now, we looked at the bond portfolio and your distribution, what you'd see as it's calculating and going through all of our bond portfolios is that it was supposed to calculate, but it didn't do a good job. Let me go back a couple of dates here. Sometimes our data is catching up. Go back to the 29th. What you see right now, though, is that we own well over 100 bonds. Our current yield, I'm getting gibberish right now, so I apologize for this. You know, what we're getting, though, is we have about a 3-year duration, so we're not going too far out. And we are also, our credit quality is clearly in the junk status here, that B rating. And our current yield is, if I went all the way down to the bottom of this thing here, you kind of see that our current yield is right around 6.7%. Now that's if we had no bankruptcies. We know we're going to have bankruptcies, right? Toys R Us went bankrupt on us here last year in my hometown of Wayne, New Jersey. We know we're always going to have some bankruptcies along the way. That's just part of investing and trying to get that 6%. So, but I still think we can make around a 5 to 6% rate of return. And a lot of great countries. McGlatchy's in the process of paying back. They're like the Sacramento Bee and the Raleigh News and Observer, and just a lot of great companies that we own. Netflix, we own the debt, and so that's what we're doing on the bond side for you, is making sure that you don't have more than 0.25% in any one bond, and keeping things well diversified to continually get you that stream of income, that just under 5% a year, dividends from the stocks and interest payments from the bonds in your portfolio. When a downgrade occurs, we're often buyers too. This was a study that was done that I like to show that it's something where the company really hasn't appreciably changed, but there's a lot of noise and everybody gets excited and the bond falls off just because the company goes from BBB minus and gets downgraded by Moody's or Standard & Poor to BB plus. Nothing's really changed. The probability of bankruptcy is still quite low. But banks and investment managers who have to manage bonds that stay investment grade because they're mandated to do that, well, you allow me to be unconstrained in our thinking. We're not, you allow me to get you a rate of return and I'm able to go anywhere. So we're happy to see this company selling off. We're happy to sit there with a big barrel and just pick up those bonds. And usually, as you can see, the bond recovers in price. And during that 20, 30, 40 week period, we're able to make a nice rate of return while others were panicking, which again goes to value investing. And I'll talk a little bit more about bonds here too. Again, there's just very low yield right now. We don't invest in hope. It's not a strategy. We're investing in cash flow for our clients. And because of that, again, our portfolio positioning right now is basically 50-50, right? A little bit more in stock than bonds, but still a good chunk right now, certainly in bonds to hedge the risks that are out there. Our bond portfolio is staying short-term from a duration standpoint, unlike the aggregate bond index, which is getting a much lower yield. We're getting more than double with a lot less duration. And our stock portfolio, again, getting a very nice, both our international stocks getting a nice almost 4% dividend yield, and our international stocks also getting 4%. So we're getting some nice yield from our portfolio. So that's how we're positioned right now. And that's sort of a in-depth consolidated outlook. And last thing I'll discuss is, since I was talking about Avis budget, I'll show you that I often say that the bonds we own are a lot like young doctors coming right out of med school. You'll see that a young doctor, when you're coming out of med school, think of it this way: you've got a lot of debt, right? So you got, let's say, $300,000 of credit card debt, and let's say you come out and you're a specialist and you're making $500,000 a year. Well, BB&T Bank or a local bank is happy to lend you $1 million for your new home. And they're happy to lend you that because they'll even lend you, even if you're making $300,000 a year, they'll lend you that 300% debt to GDP ratio. But the doctor's got a lot of debt, right? Because he's got the $1 million of household debt, he's got a $300,000 of credit card debt, but he's got good cash flow. He's making $500,000 a year in income, so he can pay his $15,000 a year, or let's say for the $1 million mortgage he's paying, let's call it $5,000 a month or whatever he's paying a month. But he can do that. He can pay that because he's making $500,000 a year, and he can make those interest payments. Now, if BB&T came along and said, "Hey, Doc, it's 5 years later, and pay us back the $1 million you owe us on your 5-year adjustable rate mortgage," well, the doctor would say, I don't have $1 million. I just started out in business. I just started saving. I've got $300,000 in medical school debt I'm still putting away for. I've got $500,000 of income. I could keep paying my interest payments. That's exactly like the companies that we're investing in. If you look at Avis Budget, you see that, let me pull Avis up here, which has a cool symbol. It's car, their symbol. And if we went back to the financial crisis, the Great Recession, what you'd notice, of course, is that they were making $6 billion a year, and they declined because you and I stopped renting cars, right? In 2009 and 2010, we stopped going out and traveling as much, so people were renting less cars. Now, they've done a great job of increasing their revenue to $6 billion, $7 billion, just under $8 billion, and now they're up to just under $9 billion in total revenue. Their cost of revenue's gone up too, although you can see what they did was they cut from 3.1 billion down to 2.6 for a couple of years. So they were cutting costs too, trying to mind their bottom line. Same thing with their operating expenses, went from just under 7 billion here to down to 4.7. So their operating income, other than when they lost almost 900 million here in 2008, they've been profitable all these years. They're like that young doctor, right? They're making a good income. They're living within their means, and Avis Budget's out there growing their bottom line and top line prudently. Now they're paying you and I $211 million a year in interest. But after they pay that interest, let me change the color here to kind of make this look a little bit better. After they pay you and I that $211 million in interest payments, or as they have done over the last 10 years, they're still paying their interest payments. They've been able to make a nice profit. Now they're not killing it. They're not making millions and millions. They only made 36 million in 2011. They made 300 million here in 2012. Just less than 211 million last year. But regardless, all we care about is that they still stay profitable. Most of the companies, approximately 80% of the companies that we invest in, are not investments with hope. They have good cash flow. They have interest coverage. That's the type of company I really love talking about. Now this, by the way, this is, I think, like 90-something% of businesses in America are small businesses, right? And small businesses make up, depending on what survey you look at, something like 50% of all the jobs that are out there. But small businesses and many companies, even these small cap companies that are large businesses in the grand scheme of things, billion-dollar businesses like Avis Budget and others, they don't have gigantic balance sheets. We're not going to lend money to Apple because it'd be like lending money to the U.S. government. We're going to get zero rate of return, right? We're going to get a tiny rate of return. We need to get paid for the risk. So I've always believed that Wall Street had it backwards. Wall Street is always taking too much risk when it comes to stocks. They should be taking less risk when it comes to stocks. When stocks, they should be hitting singles, right? Here's where you're investing in companies like Procter & Gamble. You're investing in companies that have good earnings, they're durable businesses, that are selling at reasonable valuations of global growth generation opportunities. That's what we're looking to invest in stocks. Take less risk. Don't invest in the sexy stocks that your friends talk about on the golf course. You could play around with little accounts like that, but that's not how you invest. Now, conversely, bonds are the exact opposite, right? Your bonds are like your crazy uncle that you throw in the closet on Thanksgiving. Bond investors are always so scared, they never take any risk. And you can't get paid for the return. You should be taking more risk. And I'm trying to come up with a symbol like this. If anybody comes up with this, you can let me know. I'm trying to come up with something for my book to kind of show this. But bonds, you should be taking more risk. You should be getting paid for the risk, where we're trying to make that 6% rate of return for our bond portfolio. And then overall, again, if we can make 8% a year for our stocks and 6%, if I could guarantee you a 6% rate of return like we've done over the last 15 years, you'd probably take it, right? And that's exactly what we're trying to do when I build a portfolio for you that includes both stocks and bonds for a nice balanced portfolio. To be able to get you to a nice, comfortable, and prudent risk-adjusted return to keep you in retirement during your retirement years and to remain wealthy. So at that, I'll throw it out to any other questions to you if you have for the night. Any other questions out there, either economic or portfolio positioning or anything else that's on your mind?
I have a question as it relates to economics and transitioning into the late cycle. as we see the Fed unwind the balance sheet and interest rates going up, kind of a double-edged sword, what kind of impact do you think that's going to have on the economy over the next 2 or 3 years?
Hey, Zach, it's nice to hear from you. How you doing?
Yeah, good to hear from you too, man.
Hey. So you're asking about the Fed raising rates? Is that
more specifically about the balance sheet, and at October will be $50 billion a month coming due from the Federal Reserve if they stay on schedule.
Yeah, so that's a good question. Like I'd say 5 years ago, or maybe 8 years ago, everybody was really worried about, or most people were, because we're in uncharted territory, right? This asset purchasing programs that the Fed's doing, and obviously having a huge balance sheet. And at the time, I said, well, I think the Fed's just going to be allowing those bonds to mature and naturally roll off of their balance sheet. Now we're still in uncharted territory because it's never been done, but that seems to have been what's happening nicely. Is the Fed's just obviously not purchasing anymore, but effectively letting those bonds mature, and at the same time raising interest rates, and they've got to be careful. I think that Powell's doing a very nice job in that he's probably not quite as dovish as Yellen was, who I also thought was doing a nice job, but they want to be careful. They don't want to make the mistakes that from 1937 when we raised interest rates too fast and pushed us into a recession. But they also don't want inflation to get carried away. If you look at here's CPI, and you probably studied this. If back in the late 1880s here, or early 1880s, of course, we had huge inflation. And Paul Volcker, the great period of time where economists have to learn from, one is from the Great Depression, to lower interest rates rapidly and keep them low, don't raise them too quickly. But the other one is to not let inflation get out of check. So inflation's a lot easier to fight, right? So if we see it, the Fed can force a recession, which is what Volcker did here. And you said we quickly went into a recession, then we went to another one. And that drove rates down very dramatically through the early 80s. This was very tough on Reagan's presidency in the early part here too, but it was tough medicine that Volcker had to do to get the economy back on track and stop that hyperinflation. So fighting deflation is much tougher, kind of like where we were here, where the Fed dropped the rates to zero, and then began this asset purchase because we were in extraordinary times, right? This recession was much worse than any other previous, except for the Great Depression. So the Fed acted dramatically, as did the government, and I think that was the right medicine. And now we're starting to raise interest rates, and I think they'll do it prudently. And will they send us into a recession? Yeah, it's definitely possible that they could, but not always, right? There's plenty of times when, going back to that chart that I showed, let's see, where was it? It's one of the first ones on the most recent presentation I just sent out. I kind of show the track that the Fed's on here, and of course there's like a 90-something%. You can kind of see they're ratcheting up, right? They're doing this quarter point, kind of holding, quarter point. Now, you hear people talking about, are we going to get back to normal? Well, I don't really know what normal is, and I don't think we're in normal times. And we're certainly, as I showed earlier in the presentation, we're a lot higher. Our spread to the rest of the world is, even going back to 1994, is the highest it's been. So we don't want to get too high, and certainly the Trump administration doesn't like a strong dollar, and this will make the dollar even stronger. So the Fed could cause, if I put the recessions in here, you'd notice a lot of times when the Fed is raising rates that they push us into a recession, but not always. It could often also be a stock market collapse or some other exogenous outside event that causes the next recession. So they don't catch it perfectly, but I think they're gonna slowly keep watching the economy here. If we have tariffs enacted, I think they'll hold for a while. They'll realize that's going to be a negative for the market and the economy, so they likely won't raise rates that quickly if that happens. But the Fed doesn't know, right? They're just men and women. And they're just economists, and we economists are guessers. So I don't think that they're on track, and this is what they want to do. But the market is also telling them, yeah, go ahead. The economy's doing well. You can go ahead and raise a quarter point. or when they're nervous, they're telling the Fed, hey, don't do anything yet. This economy is not on sound ground yet. And we only had this 2% GDP over this period of time. This has been a very shallow recovery. So, yeah, there have been periods of time when the Fed's raised too quickly in sense of recession, but there have been plenty of periods of time when the Fed's kind of, threaded the needle and gotten it right too. And, nobody knows when the next recession's coming. So it's one of those things where it's coming and we'll have to hold Procter & Gamble through it and just collect our dividend and not try to time it. Did I answer your question, Zach? I'm not sure.
Yeah, I mean, it does too around rates, but as far as the Fed balance sheet and the money they're letting roll off, I mean, they'll be at full capacity as of October, $50 billion a month coming due, and trying to get the balance sheet down to 2.5 from 4.5. It's kind of more my question on what kind of impact you think that's going to have, and less about rising interest rates.
Yeah, I don't know, because we haven't been there before, right, as this comes off. But even when we were at much higher to where we are today, it's unwound, and a lot of people are really concerned about that, especially on the right. They were like, oh, this is horrible, it's unprecedented. But they've done a good job of unwinding the balance sheet, and it has come down. And I'm less concerned actually about that, because I think it'll just naturally unwind and come off of their balance sheet. The Fed's a private company, right? Sort of government-sponsored entity. They can do whatever they want, and they're not going to take a loss on that money. They'll just hold it, collect the interest payments on it until it comes due. And when it unwinds, it unwinds. I'm much more concerned about them raising rates too quickly. But I think they're watching the PC number very closely, and if you look at those numbers and you look at the PC indicator here, if I pulled it up, it's given the Fed pretty good room. They don't necessarily have to raise interest rates, right now. Now, if you go back to tariffs, if I double clicked on this, the year over year, we go back to tariffs. Tariffs could be very inflationary. When you're putting 25% tax on something coming in, that raises the price that gets passed on. I think companies are sort of using that as an excuse across the board. We heard Coca-Cola just recently, talk about that. But, that 2% number is sort of the golden rule for the Fed, and we're right around it right now. If we saw it starting to heat up here, then, maybe the Fed will have to raise rates quicker, but they have that dual mandate. So I'm more concerned about that than the unwinding of the balance sheet.
Okay. Thank you.
You bet. Yeah, I hope you're well, and take care. Give me a ring sometime. We'll have to catch up. Anybody else have any questions? So I'll wrap it up. And as always, we appreciate your trust and confidence. And we'll make a tape of this and put it out for anybody else who wanted to listen to it. We had pretty good participation tonight. So thanks for joining and call. Again, we appreciate your trust, and don't take lightly the confidence that you've put in our firm. I know it's the worry that I have, and staying up late. If you get an email, if you email me at 11 o'clock on a Friday night, you get an email back, and I think sometimes clients just pay me to take on the worry of the market. So again, thanks very much, and appreciate your time tonight. All right, bye-bye.